We often think of the market in terms of numbers, charts, and hard data. But what if one of the most powerful forces is actually emotion? Today, we're going to explore a really fascinating tool that tries to measure that collective mood of investors, and more importantly, what it might signal about where we're headed next. I mean, think about it. The market's mood, right? That collective wave of fear and greed is a huge driver of price action. But how in the world do you measure a feeling? For decades, that's really been the million-dollar question for investors who are trying to get an edge. Well, it turns out there's a long-running project from the American Association of Individual Investors. You'll hear them called AAII. Since way back in 1987, they've been systematically polling their members, creating this incredibly consistent historical record of how individual investors are feeling about the market's future. Okay, so to really grasp the value here, we need to look under the hood a little bit. Let's break down how this survey, this instrument, is actually put together, because its power really comes from its unwavering consistency over such a long period of time. So here's the core of it. Every single week, like clockwork, the AAII asks its members this exact same question. And keep in mind, these aren't just random people. They're typically experienced, hands-on investors. Their responses get collected, and what you get is this direct, unfiltered snapshot of their expectations for the next 6 months. So you've got all this raw data. Bullish, bearish, neutral. But what analysts do is distill it down into one really elegant number. They calculate something called the bull-bear spread. It's simple, really. You just subtract the percentage of bearish investors from the percentage of bullish ones. And that single metric, that gives us a clear, trackable reading of the market's net mood at any given time. And this is where we get to the survey's most powerful application. It operates on a principle that might seem a little counterintuitive at first, but it's been historically very effective. It's not really about following the crowd. It's about understanding what it means when the crowd goes to an extreme. Okay, so this is where things get really interesting. See, the survey's true power isn't in telling you to do what everyone else is doing. It's a tool to watch for when the crowd gets too confident or too scared. Just think about it logically. If absolutely everyone is bullish and has already bought in, who's left to push prices higher? And on the flip side, if everyone is bearish and has already sold, well, who's left to sell? These extreme points are often where the market finds its major turning points. And you don't have to take my word for it. The numbers back this up in a really powerful way. If you look back through history, during periods when investors were at their most fearful, when sentiment was just in the gutter and every headline was screaming sell, the market's average return over the next 6 months was a surprisingly strong 9.4%. It's just a powerful reminder that the best time to buy is often when it feels the absolute worst. And what about the other side of the coin? Well, when everyone was euphoric, totally convinced the market could only go up, that party often didn't last long. The average 6-month return following those periods of extreme optimism was much, much lower, at just 3.3%. It's a classic case of market psychology playing out, Once everyone is already on board, the remaining upside is often pretty limited. So that's the theory, but how does this play out in the real world? Let's walk through a more recent example. We can track the ebb and flow of sentiment through 2025 and into 2026 to really see how this indicator can tell a compelling story about the market's journey. Okay, so let's say in the spring of 2025, the mood just turned dark. The bull-bear spread plunged all the way to negative 40%. Now, that's a level of extreme pessimism that we typically only see during major market bottoms. For a contrarian investor, a number like that is a flashing signal that maybe, just maybe, the fear has gone too far and a turning point could be near. Then, as the market started to find its footing and heal through the summer and into the fall, you could actually see that fear begin to recede in the data. The sentiment readings climbed out of that deep hole, telling us that the raw panic was fading and a more cautious, sort of tentative mood was starting to take its place. And by the time we got to the start of 2026, the transformation was complete. The bull-bear spread was now in healthy positive territory, plus 15%. This was a clear sign that confidence was back in the driver's seat. It's just a perfect example of how tracking sentiment's journey gives you a much deeper understanding of the market's underlying story. All right, so this seems like a pretty powerful indicator, right? But it's crucial to view it with a balanced perspective. Like any tool in an analyst's toolkit, it has some significant strengths, but also some important limitations you've got to be aware of. So, what makes this survey so valuable? Well, for one, it's history. It's been running since 1987, which gives us a massive amount of data to work with. It's also a very direct and simple measure of how investors are feeling, and its track record as a contrarian signal at market peaks and troughs, it's pretty impressive. But, and this is a big but, it's not a crystal ball. It's so important to remember this survey is just one data point. It's really most powerful at the extremes. And it tells you what investors are feeling, not necessarily what they're actually doing with their portfolios. That's a really key distinction to make. So, with all that context in mind, how can an investor or a trader effectively use this tool in a broader strategy? The key is not to use it in isolation, but to weave its insights into a more complete analytical process. So, how do you actually put this into practice? Well, think of it as a confirmation tool. Let's say you're seeing technical signs of a market bottom, and at the same time, sentiment is just in the gutter. That's a really powerful combination. Or if everyone is extremely bullish while the market looks overextended, maybe that's a signal to just take a look at your risk exposure. It's all about using sentiment to add another layer of conviction to the decisions you're already considering. In the end, the AAII survey is a powerful reminder that markets are driven by people, and well, people are driven by emotions. It's a tool that can help you better understand the story the market is telling. And maybe, just maybe, it can help you make a better decision about when it makes sense to listen to the crowd and when it's time to bet against it.